Okay, so that's where we're going to start. We're actually going to start with our question that came in via email from Michael B., which is an incorrect spelling. I can't adjust it here. But anyway, Michael B., sorry about the misspelling there. Michael's question was, what trading strategy do you use in the current market conditions? And in every Friday webinar, and almost for about 2.5 years, it's the same answer, short answer as before. In my personal account, 40 to 50% of my positions are in radioactive trades. Currently, 3 positions are open right now, and they're essentially at a wash. We'll take a look at those. Interactive Brokers, which I opened as a radioactive trade, a married put position done in a unique way, that was up about 4% prior to yesterday's hiccup. And someone opened their mouth and something happened. And so there we saw some little declines and some little changes. So it was at about a 3.4, 3.6% gain, and then it went back to a loss. Now it's back to essentially a break even after today, as Sam had mentioned, at the market reversal. 15% of my portfolio is in bull puts using the weekly bull put structure and power options. That part is up 21% since January 3rd. It would be 41% without the losses experienced that we saw a couple weeks ago. We talked about the 2 or 3 bull puts I had that were losing because of the February 2nd to February 5th volatility crush. But at the same time, 1 to 2% of my portfolio was in VIX calls. And I put the extended profit in there because in that webinar we saw how that extended profit worked from about a $600 investment, which countered all the losses on the bull puts themselves and enhanced the whole gains. 15% are in calendar spreads, which is up 15% since January 3rd, over about 7 to 8 positions that have been open since then. 2 are open right now, both at subtle losses. Actually, one's at a gain, one's at a loss. We'll look at that too. And about 5% of my portfolio is doing short-term straddles on stocks that have earnings coming up in 2 or 3 days. Okay, so why is that the structure? Well, it's because it's what's worked for me consistently over time. In different markets, when I did the research for the weekly bull puts and we came up with that criteria, I play around with calendar spreads. I know there are calendar spread traders out there that are doing much better than me. I'm still trying to master a technique. I like them. I'm intrigued by them. I continue to trade them. They're leveraged, but they can also be longer term or shorter term, depending on how you want to structure them. The VIX calls is to hedge that part of my portfolio, which is not protected by married put positions. So the bull puts and the calendar spreads, the VIX calls in case there's a market correction, okay? We'll get to that in a moment. But the VIX calls there are designed to hedge this part of portfolio in case those 2 or 3 bull puts I have suddenly go to 100% loss, or the calendar spreads go to an 80, 90% loss. Usually it's because of a big market correction, which would increase volatility, and that's why the VIX calls are there with 1 to 2% of my portfolio, very small amount. All right, now why? All right, so we've seen some turbulence. This is SPY, broad market indicator. But starting in 2018, we were still doing pretty good. We were following the trend. There's your VIX correction, right? That whole correction that happened, a little pullback here, lean to it, but then this is the big VIX correction. We're lost on the bull put spreads, but the VIX calls, huge return on those, okay? And then we sort of started to come back, didn't we? Things started to look to go back to bullish. We did want to have, and we did have another MACD crossover, but it never quite continued. And we had some weakness in the last 3 days, and then, you know, the glitch from yesterday, and then we came back a little bit today, okay? So this is a concern for me if this shows a positive crossover Monday or on Monday. If it shows a positive or negative crossover, I might switch from doing bull puts. I might close the bull puts I have open right now, which I think expire on the 9th. Not today. I'm doing 2 weeks out. They expire on the 9th. They're opened on the 26th. My calendar spread, the short parts there, the long calls are in April. The short calls expire next week as well. Right now they both expire. We'll see. Okay? And the married puts are further out in time. One is due in April, one's out to August, and so forth. Now, so I'm not saying that I'm not worried about a market decline. I'm saying I've structured my portfolio in the case of a broad market decline, and I'll switch at that point. But we had a little correction, and then we started to go bullish again, and now we're in another little correction. Is it a big one or is it a little one? You know, and then we saw the reversal, as Sam mentioned today. So where do we stand? I don't know yet, but I'm not quite saying that we're continuing down. Why am I bringing all that up? Well, Because Michael went on to say that in some of my married put positions, I currently stand at almost the maximum possible loss. Okay, we'll talk about that with the COG position he mentions here. Now, a lot of them are out to July and August. He says some of the reasons that this happened, it wasn't the optimal time for opening RPMs. I agree. Well, I don't agree. I opened one in January. I corrected it to take advantage of earnings. It's sitting in a wash right now, but I have twice as many puts as I own stock. Okay, that's on the Sony position. Interactive Brokers, as I mentioned, was at about a 3.5% gain after 5 days into the trade, and now it's at a subtle loss. But the put is way out in time. Okay? And you're not a fan of doing income method number 9. I'll actually show that a little bit today, and I'll kind of go through a discussion of it, cherry picking a little bit on the COG position to say why it is a bad idea and why it's not a bad idea. All right, the further going on, RPM, radioactive trade, the married put, and then the 12 different incomes, it makes sense the market's bullish. It does, but it also protects if there is the sudden correction. Because you say, but now it seems like preparation phase for the next fall. You may or may not profit in the radioactive trade depending on what income method you use if the market falls. That is true. It does work best in a bullish market, but we can manage it in different markets. That's why there's 12 different income methods. Okay? But then you said that you'd like to take advantage of the current market situation, buying good quality stocks for a better price. So you're talking about using the power options search to screen for naked puts. You sent me an attachment of what you're looking for and advices or improvements. Okay? And you use just your watch list of bullish stocks, which were currently victims of the market sell-off. Okay? Well, let's start from there. Let's navigate over to power options very quickly. And we're going to do two things here right away. And the first thing I'm going to look at is a married put. And the married put opened on January 4th for COG. I think you're in a similar position. Sorry, hold on one second. There we go. Okay, so we're just at the custom spread tool. The original position Ernie opened on January 4th was he got into shares of COG at a price of $29.15. At the same time, he bought the January 2019 30 strike put slightly in the money at the price of $3.50. So it's a married put position, but we want to use an in the money put that's further out in time. And this was the original structure. So risk of 8.1%, maybe a little bit higher than I like to take personally, but it's suited into Ernie's needs. Now, what has COG done since then? Let's take a look at that same type of chart we were looking at. Let's just go to a 3-month. And I'm just going to use, of course, SMA with the Bollinger Bands, as I showed on the last chart, and just MACD, and that's it. Okay? Why am I bringing this up? Well, the position was entered right around here, right at the peak, right where Michael mentioned. Okay? And you saw some movements, and then you saw some hesitation here. And one thing that I'd be interested in seeing, I'm not going to say Ernie did this wrong by any stretch of the imagination, but what we're going to get to with Sam and what I've done and I've mentioned before, Ernie entered this position here. And, it's got up the upper band above the 20-day moving average. You've got a positive MACD. This might have been a concern for me seeing this. It might have been a time to sell a call against the position first. But then the fall continued to happen. Might have generated some income here at the 30 strike. Might have been small. Might have done something. But now we got into this position. And then we saw this. And this started to go up. So right around in here, about 7 days ago, when the stock was around 24, I want to check something. I'm going to go back to power options. Okay? And actually, I'm going to open up a new window. And I'm going to go ahead and look at the chain for COG. I'm just going to go to the option chain. Let me clear out those drawings. I apologize. Let's get those out of the way. I'm going to look at the puts. We're going to look at January. But I'm going to go back a few days. I said about 7 days or so. So let's go back to about February 20th, maybe 21st. I didn't do this beforehand. I'm just curious. Okay, the stock's at 23.25. Need the medium chain. There we go. So this is in relation to income method number 9. There's two ways I could have gone with this. Now, we see here at this day, it's below 23.25 now, and that's about when we started to see the positive MACD crossover. Maybe it was a little bit later when the stock was 24, but let's use these numbers. A 60-cent bid-ask spread. So I could have sold to close that January 30 put I bought for about $8. And I could have bought the 25 strike put for maybe around $4.60 to $4.70. We'll put in $4.70, dollar midpoint, 50 cents. Let's say we had to pay a little bit more. We'll put in $4.75, honestly. So we're going to generate $3.25 of credit against the existing married put, but we're going to lower our insurance by 5 points. And I agree with Michael in some of this. This is a position, an adjustment that sort of helps you average down the stock without buying more shares of stock, right? I'm lowering my cost basis because of the advantage of the insurance I already had in play. So we're going to sell that one, and this would have been, as I mentioned, back on February 21st. The stock was at $23.25. Get about $8 for the January 30 put that we paid $3.50 for. And we're going to buy to open the 25 at that lower strike, but it was probably around $4.75 at the time. My risk was 8%. Now it jumps up to 15, and that's a concern. But now look, the stock's up to 25.34. The loss on the position right now, and I could add this to portfolio, we could look at it right away. With my new cost basis of $29.40, the stock's at $25.34, and the existing put is still at $2.70, let's call it, okay? $2.70. So liquidating right now, I get about $28. I'm only down $1.40, which is probably only a 3 or 4% loss because the stock's recovering. Well, I have opportunities now with the lower strike. Of course, depending on what my sentiment is of the stock, we could get some 15, 25 cents. That's not good enough. I'd have to go out to March 16th or maybe the 23rd. 26, call 35, 40 cents, but it would lower the risk. We could start doing other adjustments because the 25 put and the stock continues to move up. Our worst case break even is here. Okay, but as it started to move back up, we rolled down at the time. We increased the risk, but right now, that's if it continues down and stays down all the way to January expiration. If it comes back up, we're already at less of a loss. Another thing I could have done, and this is what you might be able to do with your stagnating positions. On that same day, remember I could have sold my 30 put for about 8. I could have bought the 25, but I could have moved it closer in time. Rather than paying $4.10, what if I only paid $2.85? Okay, so now what we're going to do here, still sell that option for $8 that we owned. We're going to combine two theories, rolling the put down to sort of average down, but also closer in time. And I said about $2.80, $2.85, I believe, for that put at that time. So paid $3.50, paying $2.85, but then we're collecting 8. We're taking our cost basis down to $27.50. The risk is 9%. But right now, again, with a cost basis of $27.50 on the entire position, we could liquidate right now at $25.34. And the July 25 puts at about $1.80. So that puts us right at about $27.10, right? $1.80, $27.10, 40-cent loss. So those are the signals I kind of use with my radioactive trades. You know, following that crossover, when I see that it bottomed out here and it started to recover, I might have used 9 here. I wouldn't have said use 9 here. You can't see that real well, can you? Maybe necessarily here when it started to pull, or here. I kind of want to wait for this if I'm expecting the stock to recover. But we talked about this a couple of weeks ago too, that idea of maybe rolling in closer in time and potentially down in strike on a stock that's not moving may cut your loss. Okay, it may generate some income, and then you just decide from there, where do you want to go if you're worried about the loss you're taking? You mentioned some of yours are at max loss. You may be able to bring it in closer. Another idea, interactive brokers. Okay, this is only up 0.4% since I got in the position. It was at 69 something. I bought in at 67.72 2 weeks ago. It went up to 69. It went up to 70.20. I was going to adjust this 70 put, but then yesterday happened, and the day, and the next day. And so here we are. At 67.99. It was down to 66 something, about $1 below where I bought it. Okay, that's just give and take. Now, let's just look at the profit and loss chart. Right now, I have a 6.6% loss on the position, and I have a small loss on the trade right now because of the recent movements, fluctuations, and volatility. But if I decided that this trade maybe is not doing what I want, I don't know if I'd go in as far as April, but I could sell the 70 put now. This would be an income method number 3, and buy the 70 here. So I'm going to get midpoint around 670, and I'm going to pay another maybe 530. So I'm getting about $1.20 in net credit, and I'm moving my put closer in time, and the risk goes down from 6.6 to 4.7. And I could still sell near-term March 70 or another one of the income methods there to reposition this, okay? But if you're treading water or if you're near max loss, you might want to evaluate moving the put in if you're concerned about taking the max loss and you're concerned about an adjustment. This isn't what I want to do with Interactive Brokers, but it's available. I could lower my risk by almost about 2% by doing this adjustment and shortening the time period. I'm not ready to do that yet. This was a hiccup that happened a few days ago. It's something that was unexpected, something we as investors couldn't really control. It just happened out of the blue, not naming names or pointing fingers. But that's what's going to happen, and you're right. We talked about this at the beginning of the year. We talked about this for the end of the year promotion at Radioactive Trading, talking about the blueprint where it describes all these adjustments and the 12 different income methods. And the idea is that we're in a market right now, clearly has been demonstrated, that it's not so much about worrying about a correction coming forward or more, although we still think that, Ernie and I still think that there's still a correction that maybe needs to occur. Some steam might need to be let off. We're in a phase now that where any new piece of news, something comes out, geopolitical, non-geopolitical, global, anything that is said or done can have a 3 or 4 point swing, 2 or 3 point swing across the markets over a 1 to 4 day period. One direction or the other, good news versus bad news. And it seems that bad news, what we're interpreting, what the market's interpreting the bad news is worse for us. Okay, those where we see the quick drops and then subtle move back. Okay, and that's what we're looking at here in that sense. So now we get into the point of the naked put that you mentioned. And you did send me your criteria. I didn't plug them in. But, oh, sorry, let me just go back to naked put home. Cover calls and naked puts. You said that you're worried about a market correction. You'd like to get into the stocks cheaper and then convert them. Well, if you're worried about a correction, this is probably the last kind of strategy you want to see right now. A long call, if you're properly position sized and not over trading, or a married put is much more superior because if there is that fall, you're only losing 5 or 6%. On a long call, you're losing 100% or 80% of what you invested in. So this idea, if you're trying to prepare for another fall, which even with a stop order does not have a limit on the loss, if it goes to 0, I'm not saying it would, but that's the key, is dangerous. So in my thoughts there, setting up a search for naked puts on stocks that you want, well, you can use your own stock list. You sent me the criteria that I might expand on later. But I mean, you look for the same things. I'm going to look for a stock that has shown good growth in earnings, 5% earnings per share growth, and what a relative PE ratio. I might only look for mid to large cap or maybe even only large cap stocks. Okay, so I might just go to 2,500 or more on the market cap. Doesn't have to pay a dividend in any situation. I'm avoiding that something that has earnings between now and expiration. I'm going to take a look at that later. And right now it might be difficult, but yeah, I still want to see stocks in an uptrend. I'm going to want to see stocks that have a positive MACD crossover for at least the last 2 or 3 days, which is going to be very difficult. And yeah, I want some good volume on average. Oop. That's measured in thousands, of course. Don't worry about RSI so much. Okay, but let me just run that search. Oh, I got to do something else. I apologize. So there are some decent stocks, but I'm going to go broader. This was looking at just a list there. There we go. Of course, U.S. Steel, Avis, Consol Energy, Lumentum. And these are 40 to 45 days out. And as a default, they're going to leave 6% out of the money or more. Well, if you're concerned about a decline, 5, 6, 7, 8%, you may want to go 10% out of the money. But at the same time, for a April 40-day out trade or so forth, standard expiration, you got to make sure it's worth your while. You're getting at least maybe a 1.5% premium. I'd go 1.2 or higher, actually, with the market where it is right now. Good volatility out there. So again, where are we back to? Consol Energy, U.S. Steel, Avis, Eldorado, Lumentum, CF Energies, Aaron's, Yelp, K-Lot 10 cores in there, Diamondback Energy, Teradyne, Herbalife, Skyworks at 109. Okay, but we went far out of the money, so you're still receiving a decent premium. I don't know if a 1.2% yield matches what you want. Because remember, if these stocks continue up, you get that that dollar premium, but you're missing out on the growth. You're not getting any of the growth if you thought these were good growth stocks. These are ones I'm considering, by the way, for a new diagonal spread. Skyworks and where was the other? Oh, not Diamondback. I'm sorry, K-Lot 10 core. Other ones I've been considering for married put recently for fusion subscribers was LITE. I traded Avis a couple years ago. I'm hesitant on U.S. Steel, but Consol Energy might be a good one too. Okay, those are just some of the ideas there that I'm going through. Okay, so all right, just wanted to mention those here. And then for the bull puts, I'm still using the default screen that we have as well. All right, so essentially that's what we're talking about. I'm just scrolling through here a lot of the comments and questions that came through. Okay, I see one down here. There's a lot of questions that have come in, multiple questions from individuals too. I see a question here. William said, I would like to sell my stock position that's quite profitable, have been holding for more than a year. William, send me the stock symbol and send me your price if you don't mind. We're going to later on walk through some other examples of that. Okay, so to answer the question via email for Michael, that's what I'm doing. And you saw it briefly for a moment. Here, we'll go back to the portfolio. So there's kind of an idea of what I would look for with those settings. You can see the screenshot here. Maybe you can go shorter term, but for next standard expiration, it's over 30 days to April. You got to make sure the yield matches what you want. 10% out of the money might be too much, but again, if you're worried about a decline, you want that. Okay? Good average stock volume, stock in an uptrend. Use the MACD crossover. That's something I use. Sometimes I'll even use the Bollinger Bands. You've seen that. Based on your price, you have to set the stock range, but you want to see a stock that's shown positive earnings last year to this year. Good earnings per share growth, controlled PE, mid to large cap stocks, and not between now and expiration. And you see some ideas. I'm not saying these are all going to be profitable. I'm not saying these are all good trades at all. I'm saying this is my starting point to do further research and analysis. Okay. Oh, where was I? I'm sorry. I was going to do one more thing while I'm here very quickly and then get to the other questions. Get to Sam's question via email and then get to others. This is actually what I'm in right now. Okay, this is the portfolio here. It's a little bit different with the cash on hand because some of these in my personal account for the radioactive trades are 300 or 400 shares, 200 or 300 shares. So the capital here, the cash on hand is not as high. But those 3 bull puts I have opened using the bull put weekly search on Monday the 6th. I'm sorry, Monday the 26th, okay, for March 9th expiration. CMG position out of the money to 287.5, 285, 319, and I'm losing money on the LRCX position. Okay, if I liquidated right now, it would be a loss. But the stock's at 194 and I'm holding the 185. So I'm still in the safe zone here. This $4.50 jump happened good today also. 2 calendar spreads I'm in, one at a small loss on Texas Instruments, one at a more significant loss because I kind of overpaid, might have overpaid for that long option there for the April 105 call. Okay, and then here's the 2 VIX calls that are actually, they were doing very well, but then today it steamed off a little bit. So I'm at a little bit of a loss here, $40 loss on that one as well. And you can see the married puts are treading water. No real gain, no real loss, and the Sony one's a 2-to-1. But I'm okay with this structure. I'm expecting these two to expire worthless on CMG and LRCX next week. Those would be a 16 and a 13% return on the investment. I'm probably going to have to manage TROW and TXN, but we'll see. I mean, it's at 108 and I'm holding the 112 call. I think this could go back up there. TROW, I'm a little bit more concerned about actually because it's right between almost both strike prices. So, but why am I still doing bullish? I showed that using the slides, okay, until I see a confirmed correction again or I start to see that negative MACD on the broad-based indexes. I'm staying with the bull puts to calendar spreads. I'm not saying this is the way you should trade, but you had asked what, are we trading right now? What am I trading right now? And that's what I'm doing right now. That's what I'm sticking with right now. I'm sticking with what has worked for me. And I'm sticking with what's protected. Those are proper position size trades covered by some light fixed calls in case the unexpected happens again. And it's not going to protect my entire portfolio, but it's going to make the loss I'm going to take on the bull put spreads a little bit easier. And I probably should have more calls in VIX right now, but I put in what I wanted to. Okay, so let's go back to the slides very quickly. And that was just for Michael there. We showed the example of income method number 9. I'm hesitant to use it at times too, but I sort of talked about when I would use it and how it would have worked out in the case of COG. And we talked about setting up the naked put search, using that criteria that we've talked about to help find good positions, okay? Now this one I'm not going to elaborate on too much. Sam is in the room. And I've got a lot of questions that came in, but Sam sent some screenshots to me today and says he would like to discuss this strategy. Sam goes in and out of different legs, and what he's saying is he thinks he's at the sell mode of the markets. Now he's looking to sell calls and buy puts in the following stocks: SPY, Tesla, Apple, Netflix, and doing the opposite on UVXY. Well, when you sell a call and you buy a put, you're in a synthetic short stock, but he's also doing straddles around this, okay? And he says, it's not a day trade. You don't have to day trade if you can't do it, but you need a margin account to sell calls or puts going back and forth to the spread. Okay, he says not that he doesn't have losers, but he cuts them short and let the winners run. Okay, and so this is where he shows what he was looking for earlier. Similar to this here, he saw that part of the breakout there, so he's looking for upside calls, and it got it going today. So he's got maybe a straddle in here or a short strangle at this portion, and then when he sees the turn, he starts buying calls. And then if he sees it turn, he'll sell those calls, maybe buy puts on the position, legging in and out of straddles. We've talked about this before. I don't do this personally. Okay, and this unfortunately didn't show up, but he says, it's a small trade. You can add puts as the market to develop on the downside. This was on SPY earlier. You can't see it there, but it says 2 straddles and 2 sold calls. Expires 2 weeks, a short trade, and will buy calls on a reversal. What's he using as a reversal? Well, again, this would have been a reversal for him, okay? And this would have been the other turn, and then deciding, well, what should he do here? Okay, so I don't like to dictate that kind of amount of trading too quickly. That's not what I typically do in my portfolio, but this is kind of what Sam is showing. He says, so if you find this works well in this kind of market, not predicting the market, take it as it develops. And he states in a cash account, you can day trade or more than 25K pattern day trader or overnight trade on margin if less than 25K. So he sold the call and long the puts, says sell the call and let the puts run, add more puts if you like, and buy calls and puts 1 month to expiry, and then of course you'd manage it at this trigger. So I don't have all of that type of statistics of what he's doing. He's just kind of showing the graphs of what he's looking for, what kind of pattern he wants. And of course you can see here he's basing his ideas on the -2 and +2 MACD levels of buying in or shorting calls or going forth and so forth. So he just wanted to share that, as he usually on Friday talks about what he's doing, what positions he's in. And again, let me go back one. As I mentioned, he's doing this right now: SPY, Tesla, Apple, Netflix, and of course the opposite, the UVXY, that volatility ETF or index. So based on sort of MACD and other trends, what he's looking for neutral, and then buying calls, getting out of the calls, buying puts perhaps to follow the downturn if he can catch it. A lot of times you might miss it with that kind of drop, but then he adjusts later on based on what he needs. So that's just sort of the review. I don't have the in-depth analysis of what the triggers are and where things go, but he wanted to share that with everyone to kind of shed light on his comments that he gives during the presentations. All right. Now, all that being said, I'm going to look through real quick. I'm going to go back over to power options again. There we go. And before I take the first question that came up from Mark, I've got some questions from Pete, Rajiv. We're all going to get to those in just a moment. Okay, Pete, you'll be second after the first question. Mark's first question came in. I'm scrolling down to the bottom. I'm sorry. As always, I got 3 or 4 questions from Rajiv. There we go. Oh, okay. And Mark said on the first email inquiry response to Michael, is the discussed naked put a naked put credit? No, he's looking at a straight naked put to get into the stock cheaper. Okay, and I showed the criteria I would use. But Mark, you bring up a very valid point. I could use that same search criteria in the bull puts 1 month out. And what would the difference be there? See, instead of just selling the naked put, I'd also be buying a further out of the money April. So I remove the large requirement of just having the naked put, let's say at the $85 strike. I might have purchased an 80 or a 75. So now I require less margin, and if the stock goes below 85, I can still get put a quality stock at a discounted price. But if it tanks and goes to 60, I can only lose that money. But I don't want to overtrade either. I still only want to do 2 or 3 contracts if I'm doing that as a naked put, depending on how much stock I can afford to buy, and try to get some premium up front. What I was doing in my personal account, of course, Mark, that I mentioned, was the bull put credit spreads. That represents 10 to 15% of my portfolio with the married puts. And I believe, speaking of Mark, let's take your question. Mark says, first question that came in once we started, I've usually been a balanced investor, as in iron condor and iron butterfly. Gave that up in December, only to finally to have the market regime change in 2018. Looking for general perspectives on the new regime for higher volatility options. Okay, I don't know what to tell you. Higher volatility positions naturally mean you'd want to be selling rather than buying. I don't think now is a good time, as I mentioned, and not all stocks are doing this. Some are moving straight up. Some had a hiccup and have recovered. But just in the last 30 days, and until what we see happening tomorrow, I don't think condors or butterflies are a good position. These swings are too severe. You say, oh, well, it's just a normal up and down trend as long as I peak here and peak down here. So I've structured my iron condor at the height of, maybe 290 on the call side and no lower than 260 on the put side. Well, okay, yeah, well, first off, we're talking about SPY, Mark, and you know better than I do that you couldn't do that on SPY right now. Even if you went out to April, the premiums are going to be so small. If you did a 290, 295, and a 260, 255, you're probably not going to have a lot of premium. Actually, I'd probably go 255, 250, because that's already been breached once in the last 30 days. So you'd be getting lower premium. Implied volatility is a double-edged sword. And what I mean by that is when I'm looking at an iron condor position, I really want the position to be as neutral as possible. Yes, I can go 30 days out. I can go 7 to 8% out of the money on both sides. I would have had 3 condors yesterday violate on the stocks I'm trading that were 7% out of the money on the put side. Even if I was only 14, 15 days away, all right, I would have had to act on that. Now, it recovered today, but that doesn't matter because when I saw that, the fear is it going further and taking the larger loss. Okay, so let's use the search, but I could go into the search for iron condor. But the thing is that when implied volatility is high as it is, that makes sense for selling. And sure, you want to sell, but it also means positions you're selling with a higher implied volatility are actually going to have a higher risk of moving against you. That's why the volatility is there. There's fear in the market going forward. So, I mean, you see a Boeing one here. Let's just take a look at this one. This is 49 days out in time. And there's some NVIDIA ones there too that come up on the list. Oh, sorry. That's not what I wanted. My apologies. There you go. Profit and loss chart. So with Boeing at 344, yeah, I'm selling at 285, some 60 points out of the money. Then my put would be the 285 and 395, so it's about 50 points. That's a good swing. It's a net credit of about 83 cents total. Because remember, if one side has higher implied volatility, the other side does too. Now, 285, now I'll do it. 285 and that 395. Okay, so it's moved up here. It's been recently close up to 375. Was at below 300, probably at around 290 2 months ago. So even though it's been here, it didn't flirt with it again here with the movements, but with this drop here, that's 25, 30 point drop almost. Okay, you drop another 30 points, you violated that put side. All right, this is not a bad return for 49 days. All right, it's a 20.6% leverage return for 40 days. But again, most of the stocks you see are going to have this pattern, based if they're following the market. That's what I don't think is a good condition for these kind of things. You want to sell into implied volatility, but which side do you want to be on? As butterflies especially, get the better premium with using the at-the-money positions, but then they go against you so fast when there's a correction like we saw the past few days. A market hiccup we saw the past few days. Right? So selling to take advantage of the premium right now, I don't know it's a good idea. What Sam said, maybe a sort of longer-term straddle or strangle was selling near-term against it, following the trend. That's his approach. I'm not doing that personally. That's his approach. And that might help you take advantage of some of the implied volatility, buying 2 or 3 months out into lower volatility if possible. But again, you're going to have to catch it quickly when you're selling things such as a short straddle, a short strangle. You're trying to take advantage of the higher implied volatility by selling, or selling against even a long straddle, long strangle structure. Because if you don't, it can get away from you. You have to be able to cut them short, and you have to be able to watch them continuously. That's another factor why I'm trading is because I don't have to watch those positions as consistently as doing something else. Because what I do during the day is more along the lines of coaching sessions, webinars, work on products, and so forth. I'm not watching the market the entire day. And I know Sam really isn't either, but on some of his positions, he has to pay attention to those switches. Okay? So, Mark, you had mentioned it's not really a question. You're looking for a new regime going forward. I might step back for the weekend, take a breather, and say that, yeah, maybe iron condors were good. You've gotten out of those, but the condors were probably good. But at the same time now, with the heightened implied volatility and the movement you've just seen in the last 30 days, how many condors or butterflies would have been violated and had to have been adjusted before you could do anything? Okay, before you could even get out of them? Or would you have rolled them yesterday and had to go further out to avoid a loss, only to today see them kind of come back to a normal range where you would have been at profitability? That's the danger I'm scared about with things such as short straddles, short strangles, iron butterflies, iron condors, anything that's neutral to bullish. And again, yes, I'm doing the out-of-the-money bull put spreads shorter term, 10 to 14 days out in time. Calendar spreads with the long calls maybe 2 to 3 months out when I open the position, but using shorter term 1 or 2 week out, usually 2 week out calls against it. And the married put positions to control the risk but still have the adjustment available. Covered calls might have been tough to do recently because you would have gotten hit at the beginning of February, and just when you started to make things back up the next 2 weeks, the hiccup yesterday might have gotten you. Same with the naked puts, especially if you're trying to sell naked puts into higher implied volatility for the better premium, not looking at naked puts that are on quality stocks, as we were just discussing from Michael a moment ago. And a moment ago means 25 minutes ago. Okay, so I'm not going to say I have the right answer for you, but I don't think now is the time to look to selling into higher implied volatility for the sake of higher implied volatility, because I don't think things are as stable right now as they should be. And we've already seen 2 gaps in the last 28 days, if you think about it. 2 major movements in the last 28 days that have caused panic. So I don't think now is the time to be selling into higher implied volatility. All right. It was Pete. I'm sorry, it wasn't Patrick, it was Pete. Pete's been patient. Everyone has been patient. Pete says, I'm doing covered calls and I'm always exercise. I guess you're always assigned. If I take further away exercise price, the money is not enough. What can I do differently? Thanks. Okay. So we're in a covered call. You're not, you're assigned is typically the terminology. So when I buy a stock and sell a call, The stock moves up, I get assigned, I lose the position. It's the option buyer or the market maker, the market in general, that's exercising my call to take it away from me. Okay? So what you're saying is if you take, so you say if you take away further exercise price, so I assume what you mean by further exercise price is what we call the intrinsic gain or the appreciation, meaning I might have bought a stock at 25 and sold the 27.50 call for 10 cents because it's out of the money. But the stock went up and I got assigned at 27.50. So I made 230, which is a fantastic return. It's almost a 10% return in this fake scenario I just created. Okay, so there's nothing wrong with that. But I think what you're saying is you're concerned about only getting 10 cents for this call that's slightly out of the money, even though you're getting assigned and picking the right stocks and making the question. I'm sorry, making the return. All right, you're not getting enough premium. So how can you get more premium? Well, you're probably going to have to search for more volatile stocks, which might have a tendency to swing against you faster if there's a market adjustment. But in power options, I'm just going to go from scratch. Okay, I'm going to say we're using out of the money because you want some appreciation. Believe it or not, I'm going to use the same exact criteria that we just talked about for Michael looking for naked puts. Why? Because in a covered call position, I'm buying stock and I'm looking for growth stocks, the same as I'm doing for a naked put. And I shouldn't be selling a naked put on a stock that I wouldn't want to own. I shouldn't be buying stock in a covered call because the option offers the best premium if the stock doesn't match the normal criteria I would use to buy a stock for a longer term 2, 3, or 4 month holding. That's the best advice I can give to you. Don't trade a covered call because the premium's high if the stock criteria doesn't come anywhere near matching what you'd look for to buy a stock by itself, because it is a neutral to bullish strategy. And investors get killed trying to follow the volatility and trying to follow the best premium. That being said, what am I going to look for? Well, you have your stock price range, so you'd want to put that in first. I'm going to put in 10 to 150. I'm going to look for stocks that have shown good management and have shown good earnings per share growth over the last year. And keep my PE ratio relative, 0 to 50. You can even do another adjustment. Again, I'm only going to look for mid to large cap stocks. I don't want to follow small cap stocks, even though they offer higher percentage premium. Now, they're usually lower price stocks. They don't offer higher premium, but percentage-wise, they offer a much better premium. And I'm going to avoid earnings between now and expiration. I'm going to look for stocks that have a good average volume. This is measured in thousands, so I'm looking for stocks that average 750,000 shares per day. I want a stock in an uptrend. Depending on your time frame, if you're going 10 to 15 days out in time to use weeklies, Pete, I'd use the SMA 20. If you're going down to April to look for a little bit better premium, a little bit longer term, maybe more downside protection from the better premium, then I might use the SMA 50. And again, I'm going to look for the MACD there where it's a positive crossing for at least 3 days. Now for the premium, this depends on your time frame. If I'm going to April, no, I'm going to want at least a 3 or 4 downside protection, and percent if assigned's got to be about the same, 3%. But you're going out of the money, so you might actually lower this to 2 and maybe 4 or 5. Okay? And I'm just going to put 0% out of the money or more. Okay? But I want to hone it in using these two. I need to make sure it's at least 2%. The downside protection is showing me that I'm collecting at least 2% in premium against what I'm paying for the stock. So the stock can fall 2% before I'm losing money on the position, but I'm not collecting 0.1%. 10 cents on a $70 stock, for example, I need that to be at least 2%. And the easiest way is also to do it by time value. Make sure your option premium has at least 1% time value for a 30-day trade, 0.5% for maybe a 7 to 14-day trade. The time value, the value of the option that is not intrinsic, extrinsic value. U.S. Steel comes up with the out-of-the-money 46 call, the price of $291. Oh, I'm going to change this too. Option bid price, I do want a minimum of at least 40 or 50 cents. I'm going to put 50 cents. I'm going 49 days out. Okay, that's much better. I'm sorry. Avis is in there, slightly out of the money. 6.1% downside protection, a potential 7.6% return if you're assigned at 46 in 49 days. Okay. Why do these stocks look very similar to the ones in the naked put? Because I use the same criteria, because I want the same sort of structure. Okay, these are the ones that match my criteria now. Neutral to bullish positions in an uptrend, reasonable MACD quality, good positive earnings per share growth, mid to large cap stocks, no earnings coming up between now and expiration because I don't need that surprise, and stocks in an uptrend. And then we filled out the other criteria. So what your focus is to get premiums, you can still find good stocks with good premium, but it's the time value or the downside protection. The downside protection is just the option premium total you receive. And if you're going slightly out of the money, of course, it's all time value. But it's the time value or the option premium divided by the stock price. So it shows you two things, how much you're collecting against the stock, 2% minimum, or how much the stock can fall before you start losing money on the position. And of course, the time value is also what you're referring to. Now, you might say, well, yeah, those positions look okay, but I want better growth. You showed me Avis at 45.50 and selling the April 46. And there's another one down here too. I just want to find it real quick. We're looking at this type of covered call. There it is. It's the 47, so it's a little bit more out of the money. And it's still okay. It's still about a 4.9% downside protection. Okay. Well, you'd say, well, I want to go maybe more. I want to go to the 48 or the 49. Well, you can check the option chain there to see if it has the premium you want. But you remember, if you're trying to go 7% out of the money for 7% appreciation, there's still some here. Oh, there it is, the April 50, still at a 115. Premium on the position. Spirit Airlines, of course, is on there too. These are good volatility, but also good volatility on good stocks, or stocks that are showing the trend that we would want. Of course, U.S. Steel was boosted recently by the news the other day. CF might have been too. Okay, so that's just kind of the idea there. You can set the settings how you want. You can find better positions there so that when you're exercised or assigned on the out-of-the-money covered calls you're looking at, that you're getting enough premium. Of course, if we were doing in the money, we'd switch that slightly. I'd look for a higher downside protection, a lower percent if assigned. I'd have to, but I still want a good percent if assigned, and the percent if unchanged. The time value is really what you're looking for. Okay. Follow-up question from Mark is he's been doing, we talked about Mark and the sentiment there, the regime. And Mark said that, recently he's been a couple of bull put credit spreads here where the position has moved against him and he's bailed out of the position. And instead of getting out of the position to see things recover as we just saw, is there a better way to maybe adjust the position to maybe get out of it or stay into it? Well, it depends on your expectations going forward. There are better ways, Mark. We talk about those in our webinar for using the backtesting tool to pull up what bull puts would have shown up on my February 26th search, Monday, February 26th. There as well. The two that I'm in, of course, come up. CMG was the one I opened. Lam Research LRCX. Skyworks was one I was considering as well. It'd be looking pretty good right now. Now this position here, though, I can't get to the profit and loss chart. But let's just take a look here. I'm going to go to what's analyzed position in the back test. The worst return was on 3-1 at 11.7%. So this here, the black line is showing me the return, folks. And the stock price, QQQ and SPX. Let me scroll down one. This spread was the 101-104 spread for March 9th on Skyworks when it was at about 109-110. And the stock last 106.59, okay? So that spiked the 104. That's a short put. It spiked at that point to 110. So think about it this way. This is my short put. That's the short put of the bull put spread. We sold the 104 and bought the 101, I believe. 101. And this is the stock during this time. And this was the decline. So we were up here, a little bit above 108 still, and then boom, we dropped down to 106, and these two spiked up. Okay. But I had a 104-101 spread. What could you have done? Well, if you're worried about the stock continuing to fall, remember it was still OTM at that point. One thing you could have done is bought to close the 104 and maybe rolled down to the 103. In general, though, I probably wouldn't have with this. I know it's tough to do, but when it fell, and it probably fell and recovered a little bit, but when it fell, unless it breached this, I probably wouldn't have looked to adjust it. It's when it goes down to maybe 104.50 or maybe even 103.50 that I'm concerned about adjustments. But one adjustment is I might have just rolled this down. It would have cost me a debit, but I still might have been able to be at a profit, a much smaller profit, but now at the 102 or maybe the 103 strike, a little bit more breadth on the position. Is it advisable in this case to buy back the short and leave the long open? Only if you really, really feel strongly the market's going to continue down. Okay, because you're going to pay so much to buy back that 104 put, what essentially you're going to be left with is a long put position at 101 where the debit is equal to the buyback cost of the 104, which would have been pretty high the other day at 106, but the buyback cost minus the net credit. So instead of this only being 20 cents or 30 cents, it might have gapped up to a 101 put with a cost of 185. And then today, well, we see what happens there. It's barely at $1. Okay, so that's kind of a tricky one too. If you think the stock's going to continue to fall, that might be a good play. But if you just think it's a 2-day or 3-day hiccup, then don't do it. If I was in Skyworks the other day, I probably wouldn't have rolled it, to tell you the truth. This is for the March 9th expiration. If it was for March 2nd expiration, if it was for this Friday's expiration mark, I probably would have adjusted it. I probably would have rolled down a strike if I could still be at profit. Maybe roll to the 102 or the 103 if that would still keep me above a profit. And then today I'd say, okay, well, I didn't make the 14% I originally expected on the vertical spread, but I'm still making 3 or 4%, which is better than closing it entirely yesterday and taking the loss. It's a trade-off. So yeah, those are some of the ideas that we talk about in that full webinar on managing your bull put spreads. Again, you can just go to the free webinars section underneath the main home tab, options strategies, and managing your spread positions. Okay, so in general, when that happens, instead of closing it, I have to go through, and we talk about it in the webinar, but I have to go through those steps. Do I think it's part of a larger market correction? Is it really close or below my short put strike price? If it is, I probably will adjust. If not, I may just adjust it going forward, okay? So as I said with Skyworks at 106, I might not have adjusted it, would have waited. If it continued to fall today, drop down to 104.50, I might have closed the position same as you did. Or I might have just rolled it down. Roll the short put down first, give myself more breath, and if it continues down, I'm probably getting out of the trade entirely in that sense. Does it make sense to just buy back the short for the extra premium and close the put? Well, not necessarily, okay? Because then it still has to continue down as well. So in that case, it's all going to depend. And of course, the call's reversed. I'm sorry, Mark. The call's reversed too. I would do that the other way. So if I'm in a bear call spread and it starts to get violated, I may roll the put or the short call up one strike, buy it back, and move it up one, or I may do that as well. Okay. All right. From Pete's question earlier, we talked about that. I think this is where Martin came in. I'm scrolling back down there as well. Martin said, why don't you roll the short call forward? That's always a choice, Pete. If you're looking to get exercise, if you're getting assigned consistently early, that's just happening to you probably, if it's happening to you. Let me rephrase that. If you're getting assigned early on a consistent basis, you're experiencing something I don't think I've ever seen before. I've had customers maybe 1 or 2 times a year get assigned early, not consistently. But Martin's comment is, look, if you weren't happy with the premium that you got aside from the appreciation, roll the call further out. That's always another option, is roll the call further out. But in general, what I'd prefer you to see, Pete, is to set up a structure of criteria that match your goals, not just for being assigned, okay, not just for the max return on the covered call, but making sure the time value you're receiving and the downside protection matches your goals, and that you're not just chasing volatility. You're also chasing quality stocks. But Martin's got a good point. If I'm not happy with the return, number one, I shouldn't have opened the trade to begin with unless it matched my trading plan. I don't want to just pick a covered call position out of nowhere and sell the premium and say, oh, I really didn't like that one. No, it has to match my structure. It has to match my trading plan. Otherwise, I wouldn't have gotten into it. But at the same time, if you're not happy with it, you can always roll it out further to try to increase the return, especially if you think the stock is good. So don't wait till expiration is what Martin's saying. Roll it out ahead of time. Buy back your calls this week and roll them out 2 weeks or 1 week in the future to get a little bit more premium rather than worry about being assigned right now. Okay, Mark made a comment here on some of what we were talking about. It says he was commenting on the great exploration use of the power options and the stock search panels, and he says he admits his failure hasn't been he hasn't been going through it as much as he should. But is there a comprehensive manual on all the search criteria, including whether the number you enter is thousands, millions, or percent? No, it's a shortfall on my part. I'll be honest with you. It's not there yet, Mark. It's not there now. We've discussed some of the discussion there also. In the webinars. I can't remember what section I put it in, unfortunately. Was it getting started? Yeah, here's a basic one. Getting started with the search tool and the criteria. It's not a manual. I can work on a manual for you. I thought there was another one in here. I'll have to find it for you. It's not in strategies, but I thought it was in this section under options concepts. But there's one there, getting started with the search tools. Oh, that's the one I was looking for. What is behind the search criteria? So we cover the main ones in this particular webinar, but it's not a manual. I'll have to work on a manual for you, Mark, in that case. All right. We've addressed this a couple times. Next question coming in from Fernando. He says, as a base structure with limited defined risk, is it possible to use a back spread instead of a married put with the same concept of using income methods to cancel risk? No, I don't think so. Okay. By definition, not by definition, let's stick with Skyworks, okay? And I'll tell you, we'll just run some base comparisons without going back in time and trying to do things historically. So I'll buy 100 shares of this, and I'm going out to August at least. So but I'm going to stick with August. I'm probably going to the 115 put. I'd probably go to the 110. No, I'll stick with, yeah, I'll go to the 110. I didn't realize the volatility in August was that low. It's slightly money. Now watch, I'm going to try to open this position on Monday. Yeah, 7.4. I'm going with the 110 right at the money there, okay? So max risk of 7.4% if the stock falls, unlimited upside, and protection out to August, Fernando. 170 days. 7.4% risk, mathematically 884. Okay. Now, the goal, the back spread or the ratio spread in any matter can be used one of two ways. Now, of course, it could be used to mimic and have a defined risk. But in order to have the time frame, I'm going to have to go out to August. So in this case, what am I going to buy one and sell two, I guess? Maybe I did that wrong, but that's all right. This, I think, is what no, this is not what I wanted. Yeah, that's not what I wanted. I wanted to flip that. My apologies. And I might even change the strikes, but I'm going to use that. Come on. There we go. All right. So this is a different way of doing it that gives you unlimited upside profit because you bought twice as many as you've sold. And you can even flip this. And maybe that's what you wanted to do. See, I get so confused on the different types of ratio spreads, ratio back spreads, front slide call spreads. Sorry, selling one. All right. Okay. But you see here, in both situations, the monetary risk was higher. My risk was $884, yes, by using a large investment on the position of over $10,000. Here you're investing about $11.95. That's with the monetary requirement of the bear call spread. Right, bear call spread in this case. And your risk is about 300 points higher, which is about 33% higher. The other one we saw was a risk of 14% or $1,415, so it's not quite double, but it's about 75–80% higher than what I'm risking. In this scenario, you do have the right, if the stock moves up as you expect, okay, to potentially buy 100 shares of stock at 110, but you don't own the put to protect it. Then you'd have to buy the put too if you want to stay in it further. Can you do the other income methods against it? Well, you maybe can depending on your broker, but you need a margin requirement. And now you're trading all options positions. The risk is going to continue to be in the percentages. Why is this a fear? Why don't we advocate this? Because you're not going to do this. You're not going to do 1 and 2. You're going to say, well, Mike invested $10,900 into the stock and around $1,200 on the put. So he's got $12,100 invested. I can get in with 1 contract and 2 for only $700. Something tells me you're going to trade 5 and 10 and only have an investment of $3,000, 1/4 of what I have. But now you have a risk of $6,185 or something along those lines. I'm risking $884, which represents 2% of my total portfolio value. It's the risk of overtrading because you're not going to do 1-to-1. You're not going to be able to get the same risk. It's always going to be higher, and monetarily, percentage-wise, it's always higher. So the minute you start adding more shares because you think you've got a leveraged position, your risk is going double to triple to quadruple of what I'm risking with more capital. All right. So we've talked about this in some of the webinars. I'm not a fan of the back spread as a replacement. You can use the put swing too. Some investors will try to show me that, or will ask the idea about, well, instead of going out that far, or instead of doing the call side, do the put side. So maybe I can sell the 110 and buy 2 105s. And so in this case, I've already got the put in place if I'm assigned at 110. Yeah, but if the stock keeps going up, you're at a loss. See, this is what negates it. At least yours, Fernando, still had infinite gain to the upside. I'm pointing out the monetary risk. You have to be very precise and very controlled if you try the ratio back spread. But remember, you have the right to buy the stock with that ratio back spread. Okay? You can exercise one of your long calls, but you don't have the put in place. You extend it further. You miss out on other things like the dividend. Can you then start rolling the put? No, you don't own a put. So you can't use 3, 4, 9, or 12, as we discussed. You'd have to build a whole nother 3-legged option structure to properly mimic rolling the put up. Okay, you'd have to move both of your calls and then sell another call to mimic just rolling the put up in the married put. This one here, you could get shares of stock put to you at a lower price, let's call it 109 minus 970, so you might only get it at 101, and you've got 2 105 puts protecting it. That's pretty good if the stock's put to you. But now the risk is to the upside in the direction you thought the stock was going to go. That's why, to me, the ratio put spread of trying to get in at a lower price and owning twice as many puts in case of the downturn is not superior, because if you're right and the stock goes to 120, you're at a loss. You didn't do anything to fix it. So the ratio put side, and that's not what you were asking, Fernando, but some investors ask me that, and I say, no, now you're trading against yourself. You're saying, Mike, why are you buying the put? This is not you, Fernando. You know why you're buying the put. You're asking me, can you do it better with leverage? And anytime you throw in leverage, you throw in higher risk and higher percentage risk, which is gambler's ruin. Okay? But when you say that, look, Mike, you're trading against yourself because you bought a stock you expected to go up in price and you're paying so much money for a put to insure it. Well, I'm paying a lot up front, but that's the worst case scenario. I don't lose anything when I buy the put but the bid-ask spread. And they say, well, isn't this a better approach, doing the ratio put spread? Because now if the stock falls, you make money. Well, if I thought the stock was going to fall, I'm going to do a different strategy. I'm opening this with only bullish positions. I'm not opening this trade if I think the stock's going to rise, which is what I'm doing. I'm going into Skyworks because I think it has a potential to move up, not down. So why would I do this trade? That makes no sense. It makes 0 sense. Ratio call spread makes more sense, if that's my outlook, of course. But again, that doesn't solve the problem. Okay? I'm not saying you can't do it. I'm not saying ratio back spreads, as we showed, Fernando, aren't limited risk. There was a definite limited risk on that ratio call spread. We showed the ratio back spread. But percentage-wise and monetarily, it's more than the married put. And the risk of overtrading, which doesn't mean, well, it does mean you could get more return if you're right, but at the same time, you're taking on much more percentage risk of a portfolio in that case. And not all of the income methods can be duplicated because it's not really what we would call a parity trade by any stretch of the imagination. It's a limited risk trade, but you need to be disciplined and proper position sized. Otherwise, you're going to take on too high of a risk. Okay. David's comment it's a question, but there's a comment wrapped in. And David's comment might have been related to what we were talking about with Michael earlier on in the relation to radioactive trade. Because David comments, I trade the radioactive position. Let's just go back to where we were with Skyworks, or adding in that 100 shares and then buying the 1 August put for that risk of 7%, 7.5%. Okay. Okay, he says, I trade, oh, I'm sorry, David, I misunderstood. Not really a comment. He says, I trade radioactive only. When I consider income method number 6, how do I calculate my risk-reward ratio? And do you have a rule of thumb as to what you're willing to risk versus reward? 2 to 1, 3 to 1, 4 to 1. 3 to 1, but it depends. Okay, so what David's talking about is what we call income method number 6, one of the 12 income methods. What it is it's a bear call credit spread. But I just spent a whole bunch of time saying that I'm doing the married put on a stock I'm thinking I'm going to go up. Why would I do a bear call spread? Because in the context of the larger structure, it's really just a covered call with an extra long call that leaves the upside open. But if you do it too soon, and if you do it for too little a premium, which is what David is asking, you could sort of put yourself in a position where you didn't get as much benefit as you wanted for limiting risk from the credit you receive versus what you could lose in the middle. What do I mean by that? Let's say this is a radioactive trade I opened today. Well, you know, I've got 11,000, almost 12,000 invested. I've got a risk of 7.5% on the position. Okay, good reasonable risk for 170, 180 days out to August. Now, I don't want to sell a call, and this helps that I sold the 110 call, but I don't really want to sell a 110 call right now. I don't want to sell the 109 at all. But even though the 14-day out March call is offering almost $2 in premium, which would cut my risk down to 664 to the downside, it's probably a little bit too soon to sell that call. All right, so I did lower my risk by 1.5% from 7.4 down to 5.9. And if the stock's trading right at 110 in 14 days, I get a 2% return. Remember what I said. Now, I didn't actually say this, but in a lot of webinars you hear me say, when I open a radioactive trade, it's because in the first 20 to 40 days, I have the expectation, based on the chart and what I looked at, that the stock would be up 3 to 6%. If Skyworks moves up 4.5% from where it is right now, we're at about 115, 115.50. That's not good. This is where I'm projecting the stock's going to be trading. Why would I want to sell a call right now to put where I think the stock's going to be trading in the red? I don't want to do that. Okay? I'm not going to sell the call right away. I'm going to wait for the stock to move up, and then I'm going to sell the 115 or a 112 maybe, depending on where it moves. But David's saying that income method number 6, what would I do in a bear call spread, folks? I might sell, usually deeper out of the money, but I'm going to sell a call, and then I'm going to buy a higher strike call as well. Okay, so I'm still going to collect that 119 or $2. You know what? I can do better. I'm going to buy the 113. I'm going to take out the 115. All right, so I'm going to get about $2 here. I'm going to pay about $1 for the 113, so I'm still getting $1 in premium for 14 days. What's not shown here, oh, this one worked out well, is that this continues to move up after 113. Yes, I'm in a bear call spread. But what it really looks to my broker is I'm in a covered call, which caps the gain at 110, but I own a long call at 113. So in between here, what's happening? My call goes to a delta of 1, so any gain I'm getting on the stock, I'm losing on the call. So that's why it slows. But after 113, the value of the long call starts to take up. Now, the put's losing this whole time, okay? But this is the counter. What I like about this one in particular, oh, sorry, folks, is that I get about $1 premium to lower my risk by 1% right off the bat, and I don't enter back into the red. That's what I'm really looking for, David, in this scenario. But for my personal rules, it's a little bit more than $1. It's about $1.13 net credit. My risk was $8.84. In general, when I use income method number 6, and this is talked about in your blueprint, but I still want this, I still want the monetary value I get, the net credit I get, to probably be close to at least 1/4 of my initial at risk. So I might want this to be closer to $2. I could get that by going to 110, 115, but then I'd probably enter back in the red. Why am I worried about it? Because remember, this is where I thought the stock is going to be trading. This is my 3 to 6% range. Okay? So when I opened this position, it's because I thought the stock would go up 3 to 6%, which is pushing me right into here. If we did the 115 call and got a full $1 net credit, we'd be back in the red in our target zone. That's what I'm avoiding. I want to graph it first. I don't want to be in a position where my original expectation was here in 20 to 40 days. I just enter a position where I put myself at a loss at 20 to 40 days if that came true. Tricky. Okay, it's very tricky. I don't think that's the way to go. I'd only do it, in this case it does, move back up. So if it goes up to 115, I might be in this range, but remember I'd be up here if I just did nothing with the married put and the stock hit 115 as I expected. So my principle is 1/4 of the risk minimum, and that's for using 14 days out in time or so. If you're using 30 days out in time, I'd like you to get a third or maybe even a half, but really at least a third of the risk against the position. Make sure that this never goes negative. That's the other line, because that's your target goal. That's usually, when I first open a married put, my first right of income method number 6 would probably be in this range, but if it goes negative, how does that help me? I don't want to be at a loss with the first income method I did because the stock met my expectations. I'd want to wait a little bit, do that after the fact. Okay? All right, so that's what I look for with income method number 6. Make sure you're trying to get at least a third to a fourth of the initial max risk on the position. Make sure it doesn't go into the double negative value or go negative again as it moves up. I've seen worse ones, and a worse one would be, what if I did open the 115 in August for the lower risk? I had one of these a few weeks ago. Similar to this, but not too bad. It was a 6% risk. Customer went shorter term. Maybe did that same 113, but they own the 115 put, all right, and they have 121,000 invested. They sold a 110 call and bought a 113. This wasn't as bad, but the trick here is that the position the customer brought to me was a 0.5% gain here, 3% loss here, and needed to get to a 12% movement to get out of the red here. That's ridiculous. You got into a stock that you're bullish on. They only generated about 25 cents of net credit on a risk of about $430, I think it was, which was about 5% of the original position. Not near as good. This one's actually decent. It's not that bad. But this position that was brought to me said, how can I adjust it? You know what the stock was? The stock was right here. Okay, well, you've got to roll this just like you've got to roll a call. I'm sorry, an income method number 1. You've got to get rid of that obligation. And they didn't want to do that. They said, no, there's got to be a way I can take advantage of the long call here so I don't have to pay as much. Said, no, that's not how it works. You're 2 days to expiration. This is essentially going to zero. This is what's causing you to get out of the position, and your puts declined because you capped the gain on the stock. That's what you don't want to see. All right? You don't want to see something that only gives you a 0.2 or 0.3% return at the peak, and then you'd need about a 10 or 11% gain to get back to break even on the upside here. And this is your target range to begin with. It's not as much as the maximum risk, but it still wasn't good. That's not what we want to see. All right. Okay, I guess take a breath here. Rajiv. All right, he says, on the JC Petty position from last week, you sold the 350 put March and bought 3 put and also bought the 4 call. Cost was 0. Okay, now it's 5-cent debit with some loss. What should be a good strategy going forward? Wait till March series or close position with 0 loss if market small gap up. I'd have to say your latter there. Or close with 20% profit. Okay, there's the other follow-up. Also open on Pfizer for March series, 35.50 call, sold the 36.50 call, and seeing good strength. Should I continue end of March series or close with 20% profit? you're asking me questions, Rajiv, about this strategy. That, you know, for JCPenney, it was, I'd have to go back and look at that. You know, it's sort of like a married put, and you're saying, well, should I close the profit early for 20%? Normally, I'd say yes, but I also know that when you say 20% profit on this type of synthetic position, your short-term synthetic kind of married put position you're looking at, or long synthetic long call position you're looking at, 20% is what, 15 cents or 2 cents off 30-cent cost? Is that worth it to you monetarily? It's 20%, I understand that, but is it worth it to you monetarily? Are you getting ahead long-term with your risk-reward ratio in this strategy? You had mentioned waiting for the other March series. If you've got a position that's sort of struggling, in that case, and I don't mean struggling in that you're losing money, because you said you're making a 25% profit. What I'm kind of saying is that in this scenario, I probably want this one, yeah. I don't remember if this is what you're kind of, nope, I reversed it, I'm sorry. That's better. Okay, so yeah, this is one of the ones you were kind of in. It's almost at no cost on JCPenney. And the stock is sort of meandered down here at this lower price. You got in sort of at a zero cost, not at a debit or a credit. And they're saying wait for the next series to roll it. Well, why? What are you going to roll to? Ask yourself first, what is your expectation? If you're coming to expiration, you want to stay into it, you could go out to the farthest March series that's available. I don't know if you need to wait for the next one to come out in that case. And, you know, it might not be the same structure, but with PFE now, you're saying in a similar place, you got a 20% profit. Well, how quickly do these things turn against you from the structure that you've been building? You know, what is your win-loss ratio with this approach that you've been using is another way to ask it, really. To buy, sell, buy, yeah, something like that. It was a lower cost, though, so let me say 84. Anyway, so if you're at a 20% profit now, I don't know what Pfizer's doing, but, you know, ask yourself, the main question here is, you know what your risk is up front on each of these positions. It's usually smaller than this, I understand. But at the same time, if you're considering those positions, then what is your average win-loss ratio in this scenario? And even if you took the full loss on one, how many gains does that wipe out? Now consider complementing that with if you shut most of your gains down to 20%. And I'd you know, maybe say with spread positions like this or synthetic positions, maybe closer to 40 or 50% gain would be better for you. But taking a 20% gain, how much is that going to cut into your win-loss ratio as far as what you need to be successful with what you're doing? You know, 20% is shallow. It's a lower gain, and it's better to take the gain, of course, than take a loss. But if what do you normally make on these positions? Average. How much do you need to win versus lose to profit long term? How badly is that shifted, that win-loss ratio needed? How badly is that increased against you if you start taking 20% gains? Okay? I mean, you got to analyze that, because if you say, hey, I didn't take a loss in this position, I took a 20% gain, you open 5 or 6 more of these over the next week and you keep your 80% win-loss ratio, but you're only taking 20 to 30% when your win-loss ratio is based on taking 60 to 70, you're going to need to be right 97% of the time to profit. Okay? So you got to figure out how that adjusts your numbers. So that's what I'm saying. And you said, okay, well, for JCP, would I close at open Monday or wait for expiration? I can't answer that. And I can't answer that because I don't know what you're expecting the profit to be on Monday. Let's say it is 20%. How bad does that affect your win-loss ratio? okay? And you said I reversed this somehow. I switched this up. Did you buy here? Maybe sold this and bought this, perhaps. Or did you do a bearish one? I'm not sure. But in any case there, it's the same concept. You know, do you wait till the expiration to close it, or do you close it on Monday if you've got a 20% gain? How does that affect your strategy? Not the individual strategy you're trading on JCP or PFE, but this block of trades you're using in your portfolio that you're looking to profit with. What is your average win-loss ratio? How much do you profit when you win on average? How much do you lose when you lose on average, monetarily and percentage-wise? What does your win-loss ratio need to be successful with those numbers long-term? And of course, you can go to radioactivetrading.com and just plug that into the, hold on here, the trade simulator based on percentages. You know, if I'm going to look to make 20% return instead of 30 or 40, I'm going to, you know, if I take 20% of the 100 expect I make, at times of the maximum risk, I lose 40, okay, and invested $10,000 here, and I need to be right, I can tell by this, I'm going to need to write 87% of the time. Is that right? Oh, I reversed it. There we go. Okay, yeah, so I need to be... Oh. There we go. Okay, yeah, so about 72, 73. I was a little bit off on that with a 20 to 40 win-loss ratio. But again, I don't know if that's your win-loss ratio. If that's the gains you make against what you expected to lose, you're not, of course, doing 50% either. You'd have to adjust that too. But that's how I develop what I need to do as far as what I need in my gains or loss. Now, Rajiv, you had commented earlier on the other discussion. It says if you include a bear call credit with a naked put, it will limit the loss in case the stock goes down. No, it doesn't. It increases it. Okay? Oh, I'm sorry. No, it does, but it's not. You're talking about a naked put there. So if I did a naked put on Pfizer for March, not a married put, but I fitted a naked put at 35, and I did a reasonable bear call, that's not going to be reasonable. So I'll go 37, 50, 39 maybe. There's no premium there, but I'll do it anyway. Okay. So instead of just a naked put, I do a bear call spread to get a little bit extra premium on the position. Would help if I sold the put, huh? And so that hedges the loss if the stock falls. Yeah, but I need to get a better premium because if the stock shoots up, I lose more on the bear call than I made on the naked put. You've got to structure that just right to do that. So instead of just opening a naked put, looking for the stock to move up, and this one only gave us 27 cents, which is part of the problem. If I add a bear call, it has to be in such a way that the loss I take between the difference in strike prices doesn't put the whole position into a negative value if the stock moves up, which is what we just saw. So I have to probably use it on Skyworks as opposed to Pfizer, which has no real premium on either side. Okay. All right. I apologize. I didn't get to Daryl. This doesn't look right. He says he's long 65 April 20th, 2018 10 puts. Any optimum repair strategy? Long 65 EA. He's not talking about EA Sports because EA Sports is in the $200 range, right? Or $140 range? 125. It's not at 10. I don't know what stock it is. I can't tell. Like it says long 65 space EA point 420 space 0 space 18. So April 20th, 2018, $10 put. Any optimum repair strategy? I don't know what stock it is, so I can't tell. Could be anything, really. Could be anything. So I'm going to have to talk to Daryl about that personally this weekend. I'll send him an email and let him know because I'm not going to try to analyze a position. And he says he's down $2,000 on a 10-strike put. Well, I need to know where the put is. There's 65 contracts. Personally, I don't trade that much on one thing. 6,500 shares representing it. So I'm just looking to see if there's in there. No. Okay, so I'll talk to Daryl about that later. Yeah, I don't think it would be this, the WEAT. Is there any $10 stocks here that dropped? Oh, maybe he was on 10X. Oh, no, wait. He said he was long the puts, so it would have been a stock that moved up. Ah, sorry. Thought he said calls. Maybe it was puts. Okay, so I'm going to have to get to Daryl on that because I can't do the stock symbol, so I have no idea what even to try to analyze. But yes, if you're interested in managing long option positions that have moved against you, step one, go into the free webinars tab and check out the option strategies and calendars, bear calls, managing your long options positions. So we sort of talk about ways and some of the tools and power options. You can use that stock repair tool for a long call. The stock repair tool to help us get back to break even. You may be able to mimic that on a long call position to help you get back to break even faster. But there's other ways to approach it also, and we'll talk about it here. So management techniques for longs when the underlying security moves against you, or if even it moves in your desired direction. Okay, so you might want to check that out. Managing your long options, option strategies. It's a public page, of course. powerop.com/webinars.asp. Everyone here online knows that. Everyone that's been here before, I should say, knows that. But there, I'll send the link to everyone. poweropt.com/webinars.asp as well. All right. Well, I think that was all the questions that we had come in, both those via email and those that were asked live. And having trouble getting to where I want to be. There we go. Okay. And I just want to remind everyone, of course, that today's presentation, today's material are essentially just thoughts on your questions, designed for educational purposes and increasing investing performance and options knowledge as well. Now, any stocks or options discussed today should not be taken as direct recommendations or suggestions. As we've seen from some of the questions that came in, options involve risk, may not be suitable for all investors. Completely didn't adjust this slide from 2 weeks ago. Markets will be open on March 5th. Markets open on March 5th. So we'll see you guys Monday, of course. We'll be out and about doing our regular thing as well. If you have any questions, you can send us an email or give us a call. Of course, you can do that anytime during the weekend. You can send us an email over the weekend. One of us is likely to get back to you within just a few hours or so, of myself, Greg, or possibly Ernie as well. Okay. Whoa. Paul asked another question that's very strange, and I'm going to go back to it. I'm going to go back to the tools here. Not sure if I understand, Paul, what you're referring to here. So Paul says, let me clear up the drawings. Paul says, when writing a covered call, I've never seen to find one that has any profit. Can you show an example, please? These are all profitable. Green, I don't want to be in the money. I'm going to go with just an at the money covered call. We can go in the money too. It doesn't matter. In the money might be better. So let's just take Urban Outfitters here. There's multiple covered calls that you can select. This is the at the money screen, Paul, which means it's looking at right at the strike price. I could buy 100 shares of Urban Outfitters at $36.48 and sell the April 36 call for $3.10. Well, if I'm assigned, that's a 7.8% return as long as the stock stays above 36. Break even is 33.38. As long as the stock stays above 33.38, then I still have some profit. Okay. If you want more safety, we would go deeper in the money. I'm sorry, was that an April? Yeah, that's the standard April, but I can go into the weeklies if I want. Let's go shorter term, Paul. I'll go 14 days out. 36 call, 230, that's going to be a profit. But let's go into the 35. Let's give ourselves a little bit more downside protection. Okay, so, well, compared to the 2 week out, but not as high. I sell the 35 call in the money for March 16th. It's got a profit of $298. I'm sorry, premium of $298. This puts my cost base at $33.50. Max return, if the stock stays above 35, I get assigned. I'm out of the stock, but I make 4.5% return on investment. $150 profit, $3,300 investment for 14 days. Oh, thank you, Paul. There we go. Okay, so this is one on Urban Outfitters. Now, what I'm not showing you and what I'm not saying is that I'm not saying covered calls are a long-term profitable strategy. The last 2 years, you would have done extraordinarily well with covered calls, picking stocks that offered at least maybe a 1.5% return for a 2 week out trade. 0.7% for a 1 week out, 2.5% for a month out trade, and over the last 2 years, you would have had a hard time not making money on covered calls. But is it a long-term strategy for growth in a portfolio? You know my argument against that is no. That's why I trade with the married put technique that's opposite. It's flipped, isn't it? It's a limited risk with unlimited upside profit potential. So I can have 5 of these trades. I can open 5 positions that offer around a 4.5% return for a 14-day trade at the money, okay? And I might make it on Urban Outfitters and stock number 2 and stock number 3. Stock number 4 might drop to my break even, so I get out at a 0. But let's say that I've made 3 out of the 4 positions. I made that 4.5%. The other one was a wash. I closed it out for essentially break even. It goes right to the break even price. The call expires. I sell the stock. And the 5th one has a decline of 10 or 12%. Where am I? I'm right at break even. I was essentially right 3.5 times out of 5, or close to 72% value, but I'm at a wash. So just about any covered call that's available will have some extrinsic value and some intrinsic value, but the extrinsic value is really the profit. Okay, let's look at an option chain here for even, let's say, Apple. And we're just going to go to the call chain. Okay, so let's ignore March 2nd because that's today. But going out to March 9th, okay, here are all the strike prices. The return, if assigned, is the max return if the stock's trading above your strike price and you're assigned the stock. Well, naturally it goes higher as we go further out of the money, right? But that's speculative. That's saying that I'd buy the stock today at 176.21 and I could sell the 182.50 call and I could make 3.7%. Well, that's only if the stock's trading above 182.50. That's for next week, okay? Because it's the appreciation I'm getting. That's the profit, is the appreciation, not the option premium of only 26 cents. That's only a 0.1% downside protection. I mean, the stock drops 26%, I start to lose money. You want to be sort of in here, at the money to slightly in the money, where you can still get a reasonable return if assigned, but you have the downside protection. My fear is that maybe you're doing out of the money calls, covered calls, speculating on a market movement upwards, and when that's not happening, you're only making 0.1%. Or if the stock falls to 167.50, you've taken a loss of 10 points and only countered it by 20 cents. Yeah, that's not a way to get ahead long term. That's not a proper structure for a portfolio to profit. You're going to want to be slightly in the money to at the money. Still have a reasonable downside protection, 2%, 1.5%, but still have a good yield. Now, this is only for 7 days. Okay, you go 30 days out in time, you're going to be looking for a 3 or 4% downside protection and maybe a 2 to 2.5% return. But you're going to be in this range. You're not going to be out here where you're speculating on huge returns, which is all based on speculation on stock price appreciation. To be consistent long term, you're going to want to be here so you can still see a 1 or 2% return even on a weekly option, still have some downside protection. If you're going 30 days out in time, close to April, well, let's go next standard expiration. You see here that going to the 190 call, you say, ooh, I could make an 8.7% return. Yeah, but you're only collecting 0.8% against the stock. That means if the stock falls more than 0.8%, you're losing money on the position. You want to be in here, okay? You kind of want to be looking for a good downside protection, 3, 4, 5%, with still a good potential return if assigned. Okay, you want the protect. I'm probably looking at the 170, honestly. 2.3% return if you're assigned on the position. If you have the stock called away at 170, you still make a profit. Right? You paid 176.21, sell the 170 call, but you're going to get about $10. So you're still going to make maybe about $340, $350. That's 2.3% if you're assigned at 170. And the stock can fall close to 10 points before you start losing money on the position. Your break even would be about 166.21. Now, a lot could happen between now and April, sure, but that's the difference between going shorter term and only looking for a 0.8 or 1% return on a 7-day trade at the money, slightly in the money, versus going a full month out and having about a 6% downside protection, about a 3% return if assigned. It's all about the time value in that case. But speculating way out here, even though you're getting $1.33 for the 190 call and have an 8.7% potential max return if the stock's above 190, that's not due to the premium. That's due to the $14 appreciation from 176 to 190, which is speculative. You only have 0.8% downside protection. Okay, going out of the money for lower premium because there's a high return available might not be the best approach. You might want to be just at the money, slightly in the money, or maybe slightly out of the money if you're more risky. You should still have a reasonable return on those positions, Paul. Okay. Now we looked earlier, very quickly, we looked earlier at a position that Rajiv was in, and we saw some small premium. He's not trading this way, okay? But if I bought 100 shares of Pfizer today, I went out 14 days to the March 16th expiration, well, the 36 call right at the money is only offering 56 to 57 cents. That's not bad for a 14-day trade, right? So this is a covered call, and this is not a recommendation or suggestion. I'm saying that this is kind of what you're looking at. Well, here's the premium. I could make 1.8% return, $62 on 100 shares, or $3,500 investment if the stock is trading above 36. Well, also now we got to talk about account size. If you're only trading with $10,000, you want to do 3 trades, you're probably only entering 100 shares of stock, Pfizer, and selling 1 call. Okay, so you pay $7.95 to enter the buy right, and then you get assigned, and your broker charges you maybe another $2 or so, and some brokers don't charge any for the assignment fee or lower cost. Well, now that's $9.95. Let's just call it, in and out of the position assigned on March 16th. Your max profit was $62 if you were assigned at this price, 36. Well, which means that you took in roughly $52 worth of profit. Okay, that's the price of doing business. But this probably won't match your goals. $52 made against $3,500 invested. Yeah, it's a 1.8% return, 1.6% return, but it's $52. Okay, you didn't lose money, but you made $52. So now it comes down to a structure that you have to define for yourself. Is this the strategy to make you profitable long term? But, you know, there's other 2 ways of looking at it. If I go too deep in the money with the March 16th for protection, I drop down to the 34 call. Remember, stock's almost at 36. It's 35.95. I get 209. This is a 9 or 12 cent profit. For 100 shares, that's literally $14 in this case. And we already saw maybe 10 to 11 of it's going to be taken up with commissions round trip. I'm making $3. That's not going to cut it. So position sizing is also extraordinarily important, depending on what stocks you're using and what premium you use. Opposite end of the spectrum, you're speculating Pfizer to move up. You want to give yourself some breath. So you sell the 37 call. It was only trading at 20 cents. That's not going to cover anything, right? It's 19 cents. 50% of that's going to go to commissions. Sure, you could make 3.5% if the stock's at 37. What happens in 16 days if the stock is trading at 36.10? Okay, well, your call expires. You keep the 19 cents. Okay, you had a cost basis of, 3,576, but then you have to pay whatever $10 commission in. So really this goes back to 3,586. And you look at it, you say, well, I've got a 24-cent gain after commissions and everything else. That's not really great. No, well, you could sell the 36 call now for the next month. But again, selling the out-of-the-money call, hoping for appreciation, could be a 3.5% return in 16 days, but that's speculating on the stock going above 37. You've got to pay attention to what you're collecting, what are your costs, and what is your account size for the number of shares that you can open in this structure. Okay, that's important. But yeah, pretty much every covered call that you could look at on a stock will mostly offer return, some type of positive return. The return if assigned is the max return if you're assigned at expiration. Downside protection is also extraordinarily important because it shows you how far the stock can drop before you're losing money on the position. And you might even want to look for a 0.5, 1%, 1.5% return if unchanged, meaning if the stock doesn't move between now and expiration, make sure you're at least receiving a profit if the call is assigned or if it expires worthless, depending. Don't go too far out of the money hoping for an increase in the underlying stock price to make your profit. It's best to kind of be maybe at or slightly in the money with your covered calls, even though you're risking them getting assigned. But that's how you get the best downside protection and the best return if assigned as well, okay? NVIDIA's, okay, well, they're all profitable, okay? You say, what would the numbers look like on NVIDIA? Very quick, I can just go to the chain and just go to the call chain. And for 1 month out, for 2 month out, and these aren't trades that I would make, but look, going 2 weeks, 1 week out, 2% return, 1.5% return with good downside, even 1.2% with good, 4.7% at 0.9 with the midpoint price, getting the midpoint, okay? And these aren't wide bid-ask spreads. You probably get 925 at the 230. Going out of the money, sure, you could make 3.7, but now you're only looking at a 1% downside protection, okay? You go out to 250 and say, hey, I can get $1 premium. Yes, you can. That's only a 0.4% downside protection. Sure, you could make 6% if it's assigned, but if the stock falls 3 points, you've lost $2 the entire position. That's not a good approach long term. Again, as I said before, you're going to want to be in this, and this is just for the 1 week out. Of course, you'd never want to do a covered call if earnings are coming up between now and expiration. I haven't looked at that for NVIDIA. Going a month out, you see about 6% downside, 6% return if assigned at the money, and the numbers adjust accordingly when you go deeper in the money. Better protection, still a good 1 month return if assigned, and out of the money, little speculative with not a lot of downside protection as well. Okay? All right. So that's just sort of a rundown there of the covered calls. You say that you're not seeing any profits. Well, you might mean that they're not matching your profits, and you'd have to establish what your profits are. What are your profit ranges? What is your account size dictating? How many shares you're opening per position? Is it worth it, depending on the stocks that you're buying? Speculating out of the money, if you want to hold the stock long term and collect a dividend like income, that's okay. But remember, you just give up downside protection. You're not getting enough in case of the market fluctuation that we've seen twice already in the past 28 days. All right. Just a reminder, of course, to everyone, if you haven't tested yet, you can go to powerop.com, put in your name and email address. You can test out the tools for 14 days. We looked at the portfolio tool today extensively at some of the search criteria for covered calls and naked puts. We spent some time with a custom spread tool, looked at some iron condors. We showed the back testing tool a little bit as well for going back in time and looking at positions also. So you can have access to all that for 14 days, no billing, just your name and email address. Paul, we're past 6 o'clock, so I was trying to go as quick as I could. But if you have further questions about covered calls and why you're not feeling you're meeting your structure or what you're looking for, remember, send me an email to support@powerop.com at any time. There we go. Over the weekend. You can also call us during market hours at 302-992-792-7971 as well. And remember, the trial members and subscribers, you can schedule a coaching session also at any time. All right, well, ladies and gentlemen, thank you for the wonderful session. Thank you for your wonderful questions. I'll get this archive sort of recorded. Well, it's recorded, I'm sorry, but I'll get this transposed and converted is the term I was looking for. Get this converted for you and get that posted, and we'll let everyone know when this webinar is posted so you can come back through and check out some of the ideas and the concepts we discussed today. All right, take care, everyone. Have a fantastic weekend. I hope some of us are still here in the cyclone bomb. Some of us are probably buried under snow. Sam, you're buried under snow, I guess. We had 2 hours of snow today, but it rained for 8 hours before then, so we don't even have snow on the ground. So that's fun in the Mid-Atlantic here, but we're not getting it nearly as bad as Connecticut and New Jersey, New York, Boston, Rhode Island, and Maine, as well as Vermont. But we are getting 50 to 60 mile per hour gusts throughout the webinar, so that was kind of fun. Saw a couple flickers of electricity. But in any case, I'll get this posted. I'll let everyone know when it is available as well. And Sam says New York power outage, stormy and windy. Okay, good. So not good, but yeah, and we've seen some different ranges. All right, everyone take care. Have a fantastic weekend. We'll see you.